We may as well start with some introductions, and probably some folks will come in the interim. So welcome everyone, and thank you for joining us today. Today we have Zhaogang Song from Johns Hopkins, who will tell us about the struggles of the Federal Reserve when buying large shares of mortgage-backed securities, large amounts of mortgage-backed securities. Zhaogang wants this to be as interactive as possible in this format. So there are three ways to ask questions. The usual way is to type them in the chat. Then you are welcome to raise your hand and wait for us to call on you. There are two ways to do it depending on your version of Zoom. Some of us have the raise hand button at the bottom of the big screen. Some of us have to go to the participants list and click at the bottom of that. But then you're also welcome to just unmute yourself and ask a question during Zhaogang's talk, and he welcomes those and wants it to be as lively as possible. So Zhaogang, thank you so much for coming, and please go ahead.
Yeah, thank you so much, Andrew. Thanks a lot for the invitation. It's my great pleasure to present this paper, joined with my colleague Yu An, who is also here. So I'm gonna, ask him for help when challenging questions are raised. He's very capable of, answering challenging questions. The topic today I'm going to present is about monetary policy implementation. It's not about the macroeconomics of the monetary policies. It's about the implementations of the monetary policies. This is totally on the microstructure side. Specifically, this is about the kind of the implementation system the Federal Reserve has been using for many, many years, more than 50 years, as far as I know, in implementing all kinds of different monetary policies. The system basically is like over-the-counter trading, and Federal Reserve buys and sells securities from the market, but with primary dealers as kind of the intermediaries. It's like, in general, over-the-counter trading, we know investors, customers go to dealers and they trade. The same thing. The Federal Reserve goes into the market and they trade with dealers, specifically only a group of about 20 primary dealers. This type of implementation systems covers many different policies. The thing you are familiar with, I guess, is the quantitative easing. The Federal Reserve purchased a lot of securities, a large amount of securities from the market. What you probably are less familiar with, but maybe a lot of you know, is like even setting the federal funds rate is also involving using this system. The Federal Reserve buys, sell securities through primary dealers and to kind of push the interest rate towards their target. Okay. So there are different securities covered under this system, Treasury, Agency CMBS, and corporate bonds recently. Since the pandemic, the Federal Reserve began to purchase corporate bonds. Okay, so I'm going to focus on Agency MBS because of the data advantage. Now, clearly, as you can see from the quote, the trading outcome, as a trader of the Federal Reserve, as being a trader, they care about the trading outcome, which is competitive and appropriate pricing. I'm not sure how we define appropriate pricing, but competitive pricing, once we put in the model, we know what it means, right? But they really care about it. The first order importance question, and the rationale is very straightforward, right? So the overpaying is clearly hurting us as you as taxpayers, but it doesn't really do much help to the economy. Okay, so the question we are trying to answer, we're trying to shed light on, is exactly whether the large primary dealers can exert strong market power and extract large rates. Right? So I guess different people have different prior beliefs. I don't know what is your belief, but one way to start thinking about this is think about over-the-counter trading as a, think about the general market microstructure research in over-the-counter markets. I think in general, there is a consensus from a lot of research is that dealers do have market power against at least the ordinary investors, customers, we usually mean, right? So, but the channels are usually dealers have better information, they have better trading technology. For example, if you think about search friction, we can see we can reach to different people, but as a general investor, you really have to find the dealer first and then let the dealer to help you to get this, to other investors. But if you think about the other way, like the Fed is a customer, but it's a very special customer, right? So I'm not sure how you think about, whether the Fed has this advantage in terms of information to think about the treasury market. The Fed sets the interest rate goal, which determine the treasury prices. So in terms of trading technology, the Fed is super large. It can drag all the primary dealers here to trade together. So I'm not sure whether the Fed is in a very weak position against the primary dealers in terms of those frictions. Okay. So therefore, a priori, at least we are not very sure whether the primary dealers can still exert strong market power against the Federal Reserve. Okay. Oh, by the way, if you have questions, please do go ahead and unmute yourself. Just just raise your questions, please. So it's good to clarify the questions rather than letting me confuse you more and more later on. Okay. Now, so therefore, what we want to do is I want to show you that the answer, although I'm giving you some negative answer to the information trading technology frictions, I don't know, but still our answer to the question is still yes. But the difference here is that we have a kind of a distinct economic channel. So there are two elements in this channel in the story we have. First element is like the basic channel. Second element is like amplification channel. Okay, the first element, the basic channel, is that the Federal Reserve purchase is really, really huge. Like think about the quantitative easing, right? The Federal Reserve purchase is really large, and individual dealers' inventory capacity is kind of relatively limited or constrained relative to the huge Fed purchase amount, right? So even if think about the two dealers, they engage in price competition. If one of the dealer cannot meet the demand of the Fed, the other dealer is going to say that, wow, okay, so you're going to come to me in the end. You always have to come to me. So I become kind of a monopoly on the residual demand curve. So I'm going to charge a price over my cost, which is an uncompetitive pricing, right? So that's kind of the very intuitive idea of why, even in a price competition, because of the constraint or limited dealer capacity relative to the huge Fed purchase amount, we're going to see uncompetitive pricing. Now, the second channel is more like an amplification channel in the sense that if you think about the two dealer, if the two dealer becomes extremely asymmetric, so one dealer basically becomes like kind of a totally monopoly dealer, right? So in that sense, like relative to the symmetric case, both dealers can satisfy the demand of the Fed. If you have a very asymmetric case, you're going to end up with a monopoly market. So relative to that benchmark, we see dealer symmetry amplify kind of the uncompetitive pricing charged to the Fed. Okay. So this is just a very quick description of the economic channel or our story. So in the rest of the talk, what I'm going to do is to elaborate on the channel and give you the empirical evidence supporting the channels. Okay, but before I move on, I just want to emphasize two things. One is like the effect, as you can see, is because the Federal Reserve purchase amount relative to the individual dealer capacity, dealer symmetry, they're just the kind of the facts we know that are basically showing up everywhere in different markets, right? So in fact, in treasury markets, MBS market, corporate bond markets, it's always like this. So therefore, the effects are kind of very general. We focus on agency MBS totally for data advantage, not because this is specific to MBS market. Therefore, during my presentation, I'm trying to abstract away from the specifics of the agency MBS market. So, but I will give you some institutional details of the agency MBS market and talk more about that. Second is that the results are general in terms of the different trading protocols. The reason I want to talk about this is that for some of you, actually for my own research, I did kind of analysis on the trading protocols the Federal Reserve use to solicit offers. They do kind of like small size auction, they do large size auction. So, but as you can see, these channels, is more about kind of the inventory capacity, purchase amount. It's not really about specific trading protocol. So therefore, we believe the effects we document are still robust to various trading protocols. So that's just trying to emphasize the generality of the results. And now I'm going to move on to talk about the specific results, elaborate on the economic channels, give you empirical results about the inventory build up, trading outcome, and then I'm going to try to synthesize different effects. Okay. First, I'm going to talk about the key features and economic channels, the two elements of the economic story I have. The first element, as I said, is Fed purchase is really huge, and at the same time, it's very fast, right? So here on the left side, I have a plot giving you the quarterly issuance amount of the Fed, quarterly purchase amount of the Federal Reserve in red bars, together with the quarterly issuance amount, the total issuance amount. Okay. I also plot the mortgage rate just to tell you why the issuance first increased and then decreased. That's because the mortgage rate during the sample period first decreased and then increased. Okay. By the way, we focus on this sample period also because of the data availability. Okay. But as you can see that, the Federal Reserve, the purchase amount, the ratio of the Federal Reserve purchase relative to the issuance amount is first about 30–40%, and then jump to over 50%. That's because of the beginning of the QE3. If you remember, QE3, they are adding like 120 billion a quarter, roughly at that pace after this quarter. And later on, when the issuance declined, the Federal Reserve purchase is it's fixed there. It's always almost 120 billion a month. You can see that it's reached over 80% or even 90% of all the issuance, right? So it's basically the purchasing the whole new issuance market, right? So that's the first element. Second element, as I mentioned, is about the dealer asymmetry. So here we use the TRACE data, and we calculate the fraction of the MBS trading volume over this period. That's the May to October 2011, a few months before this period. The reason is that we want to keep things clean because you also want to use this period to measure the dealer inventory capacity. So we don't want to use the measure together simultaneous with the Fed purchase because that may distort our results, right? So we want to keep things clean. But as you can see here, there are overall, I think about 138 broker dealers. And if you look at the fraction here, like top 20 dealers account for over 95% of all the trading volume. Okay, so there is a big asymmetry between the very large dealer and the general small broker dealer. More importantly, since we focus on primary dealers, and there is even still very large asymmetry among the primary dealers. So among the primary dealers, there are a group of 20, 16 have ever sold to the Fed. So these top 16 dealers, the 16 primary dealers in total, they account for 85% of the trading volume of all the market. It's not just among the primary dealers, it's all the market. And the top 5 dealers, 5 of them actually account for, over half of that. So there is a very still large asymmetry between the large primary dealer and the small primary dealers. So that's kind of the second element in our economic story. So now I'm gonna take these two elements, put down a framework, and try to tell you why and how the uncompetitive pricing shows up, and then give us the guidance about the empirical test that we want to do. Okay. So this framework is very kind of a standard framework. It's a Bertrand adverse competition framework with capacity constraints. So if you're coming from an IO framework, I'm sure you are familiar with the framework. So so my colleague Yu actually taught me this framework. Just to give you some background, so the framework is kind of like a bridge between the traditional Bertrand competition and the Carnot competition, right? So Bertrand competition is a competitive outcome, and that's kind of people think is very strange. We call this a Bertrand paradox, because the competitive outcome with only a few dealers, oligopoly, is kind of strange, right? It's not what we see in the market, right? But the Carnot competition, although they give you the monopoly power, but the price setting mechanism is kind of strange, right? So there is an auctioneer setting the price, and the sellers are competing only on the quantity. So there is strange thing going on. So basically, this framework is using kind of price competition, but they built in the capacity constraints, and that's going to generate kind of the uncompetitive pricing that actually even support the Kuhnert outcome as an equilibrium outcome. So, but let me give you what we have here. It's going to be a extreme like simplification of the Krebs-Schenkman 83 model. So we have two dealers engaging in price competition, selling MBS to a buyer. The buyer is naturally what we think is the dealer, but we're going to do comparative statistics, think about a non-Fed customers, right? So dealers have inventory capacity. So they have X1 bar, X2 bar. We allow dealer to be asymmetric, but to, as I mentioned earlier, to have the uncompetitive pricing, we do not necessarily need the asymmetry between the dealers, right? Now, dealers' reservation value, to talk about the competitive pricing, we need to put down reservation value. We can normalize this to 0, but to talk about the alternative stories, I want to put a C here. Basically, this is kind of the reservation value. You can think about this, think of this as kind of like before selling to the Fed, dealers have to put up inventory. It's kind of an inventory sourcing cost or inventory building cost. Okay. Clearly, the inventory capacity will be related to the inventory building cost, because this is the inventory built to sell to the Fed, right? So there is a connection between them. That's going to be kind of alternative story to us, which we're going to try to rule out in empirical analysis. And the buyer seeks to buy a constant unit of MBS, D. We assume D is lower than the sum of the total inventory capacity, because if D is larger than that, we end up with a kind of a very almost a trivial case of a monopoly market, right? So the interesting case is to say how the change of D would lead to competitive outcome and uncompetitive outcome. So the dealer would submit an offer price, and at the price, PI, they'll sell up to their inventory capacity. The buyer would walk from the lower price to the higher price. Andrew, please.
Oh, Zhaogang, I just wanted to point out we have 2 questions in the chat and maybe even more questions just waiting for you to pause. So is there a good place to pause and take those questions?
Yes, I can take the questions. Like Michael, do you want to ask a question, or do you want me to read the question and answer that? I see a question from Michael.
Oh, sorry. I just figured you wanted a running commentary for when later on. It's as if you could take notes. I thought this would give you with some notes, but the gist of it is, isn't the Fed not just like this massive deal that has no limits on whatever it can do? And so why wouldn't we expect it has power over the dealers versus the other way around? In fact, I have to admit, I thought the whole point of the Fed was to try to exhaust or push the primary dealers past where they naturally want their inventory so as to change monetary policy, and that's why they're doing what they're doing.
Yes, I guess you're thinking about whether the dealers have alternative option of the dealer, right? So it's like if they don't trade with the Fed, they have to trade with someone else, and they lose the opportunity. So in that sense, they're gonna give kind of the Fed has relative some bargaining power, right? So if I'm understanding your question correctly, I think that is true. But what we focus on is that the Fed, from the Fed side, they don't have an alternative option because that's the dealers they have, and they have to think about how to make the dealers to give them the competitive pricing. So.
And then the second thought was, as a dealer, I might be willing to take a loss in trading with the Fed because it will give me more information about what the Fed is doing. And that information seems valuable across many, 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 many markets. So as an empiricist, you may be getting, because it's the Fed, there are models that suggest I'll lose to the informed if I can become informed and then beat up and take care of advantage of everybody else.
Yeah. So that's possible. That's possible. That's not, so that direction will go against the Earth because they're gonna kind of give Fed the better price, like closer to their cost, or even like, as you said, make a loss. But what we say is that we're going on the opposite direction. So even on top of that, we say they are charging the Fed an uncompetitive price. That's kind of the story we have.
Pete, would you like to ask your question?
Yeah, I was just saying that for the Fed to say it wants to buy at a competitive price, this is maybe what Michael Goldstein was saying. That's a sort of an absurd statement. It's like they're obviously, it's like Saudi Arabia wanting to sell oil at a competitive oil price. The whole purpose of it is to be non-competitive. But now that I'm making a comment, let me just provide some history here. So Shankman was my advisor at Chicago. And so when I was developing my 85 paper and my dissertation stuff, this stuff with paper with Krebs was kind of a possible way of thinking about it. So, I think they were probably thinking of market microstructure when they wrote the paper. I mean, Shankman certainly was because he was my advisor. We were talking about market microstructure. But I graduated in 81 and, they went this way. I went to my 85 paper, but where you seem to be going is more similar to my 89 paper,
Yes.
which deals with issues, kind of has a quadratic cost of holding inventory because it has risk aversion, but it also has asymmetric information, which changes the strategic way in which people behave.
Yes.
But hopefully you'll tell us why this is better than my 89 paper.
No, I don't think it's better than 89 paper. Thanks for letting me know the history. So I think what we have is like much less in terms of the strategic component of the framework is much less than what you have in your 89 paper. So what we have is just like the dealers, since we have the limited inventory capacity. If you are the dealer, you have limited inventory capacity. So I know the Fed will have to come to me in the end. So I'm gonna charge a price higher than my cost, and the Fed has to take it, right? So it's like we are fixing the Fed side. They have to finish that, right? They have to buy that amount because
so
of
dealers like to pretend that they take a lot of inventory, but my suspicion is the dealers are not taking a lot of inventory. They're just passing it along to the rest of the market. So this idea of having an inventory constraint, I don't think that's relevant either.
Right. Let me. Can I defer this question to later on? I'll show you like the inventory buildup. I'll give you some numbers. You'll see like there is a huge inventory buildup. So I'm gonna show you in like 2 minutes. That's pretty much all, right, Andrew? Just want to make sure.
Yeah, I think so.
Okay, great. So okay, again, so let me try to give you kind of the reason why there is an uncompetitive pricing coming out of this framework. Is actually very simplified. There are two cases, right? So one case is the D, the purchase demand is actually lower than even the small dealers, inventory capacity. So the Fed can go to any dealer. Any dealer can say, we have the inventory you want. So we have enough inventory you want. Okay. So in that case, we come back to the standard Bertrand outcome. So now what is more interesting is that if the fast purchase amount is larger, there are two dealers, there are big dealer, small dealer, or then you just think about two dealers. So if the fat purchase amount is larger than the dealer one's inventory capacity, dealer two is gonna say that just go ahead and trade with dealer one. In the end, you always have to come back to me. So therefore, on your residual demand, I have a monopoly power. So because I'm become the monopoly, right? So I'm gonna charge an uncompetitive price higher than my cost. Even if you know it's higher than my cost, you still have to take it because that's your only option. So we are, I think one thing I didn't flesh out very clearly that the fast choice is fixed. That's all they can do. If they can go to another dealer, even go to the broader customer, yes, of course, that's gonna soften the market power of the dealer. But right now, the framework is we are fixing the dealer. So later on, when I'm gonna tell you that the Fed is trying to bring more investors in, like insurance company, mutual funds, so that they are going on this direction. So there are two cases again, so competitive case and uncompetitive case, right? So you can say that the uncompetitive pricing does not depend on, whether X1 buy is equal to X bar, whether dealer is asymmetric or not, right? But when dealers are more asymmetric, as I mentioned earlier, So that's gonna think about the total inventory capacity. Think about the total inventory capacity as a new issuance amount. The new issuance amount is fixed there, right? So now different dealers take a different fraction if the situation becomes very asymmetric, right? So X2 bar is gonna be very, very small, X1 bar will be extremely large. We end up more into a monopoly market, right? So in that sense, the dealer symmetry is amplifying the effect, right? So we have additional implications coming from the dealer symmetry, which is a stronger dealer, very intuitively. Stronger dealer will charge on average high prices. This, the strategy is mixed, so we have a first order stochastic dominance. And the expected selling amount is also larger. So you can calculate that. But that's also very intuitive because the dealer is in a very stronger competing position. Okay, so that's kind of like very simple story. The strategic is only because of the inventory capacity. It's a very simple strategic thing going on that leads to the uncompetitive person. So now I'm gonna, as I promised to Pete, I'm gonna show you the inventory build up the results, and then I'm gonna tell you the results on the trading outcomes. But before doing that, let me just give you a little bit of institutional details. It is MBS market. We focus on this because of data advantage. This is a market that is like to be announced forward trading, which is very liquid. This is kind of like a lot of my research focus on this market. But let's take this as a given. It's a liquid market. The market, this trading is used for most of the MBS new issuance. It goes through TBA market, most of the new issuance. And the contract is kind of the cohort level. Is think about the Treasury futures, right? 10-year, 20-year Treasury futures contracts, you can still put in different securities. So here is the same thing. You can think about one trading unit or contract is like Fannie Mae 30-year, loan, fixed rate loan, 4% coupon rate, and there is a fixed settlement day in each month. I say April. So there could be several thousand or thousands of securities that are eligible to deliver. So there is a cohort chips deliver issue, but in the end, overall, all the Fed purchase, because of the cohort-based liquidity trading that is very liquid, the Fed purchase is exclusively executed in the TBA market. So the Fed purchase all their MBS only through the TBA trading. Okay, so this is the timeline in general. So Fed first announced the purchase size and the date, and then on the trading day, so they tell you exactly which day and how much they purchase. Okay, here on the trading day they solicit the offers, and in the end, because this is a forward contract, there is some time between the trading day and settlement day. Right, so that naturally leads to the question that whether dealers would get the inventory before the trade, or maybe they'll scramble for inventory from customers after the trade before the settlement day, which is what I think Pete care about. Okay, so just one quick sentence about the data. We have two data. One data is coming from the Fed disclosed with dealer identity. Second is the TRIS data with dealer identity. Is the same data used in my other two papers. So we match them because we have the dealer identity. We got a pretty good match. Like we matched almost all of them, over 9,000 Fed transactions. So they come from like 400 TBA contracts. So overall, for each TBA contract, there are about like 20 transactions in here. So this is what I owe to Peter about the inventory buildup. So let me explain this a little bit carefully. So what we do is basically, as you expect, right? So we're summing up all like the daily order flows, try to get a cumulative inventory. So we're fixing the Fed trading day at 0. We're gonna do this 6 days before, 6 days after. Okay. Now for each dealer, we're gonna get the cumulative inventory for TB contract for each dealer, and we take the average of across I and M. We got this line. Now, as you can see, for average trade of a TB contract, there is a very large build up increasing of the inventory right before the Fed transaction day. After that, it's just keep decreasing, right? So what this figure tells us, at least right now, is that the dealer does build up the inventory before the Fed transaction. It actually built a large inventory before the transaction, about 300 million for each transaction. This is for average transaction. On the Fed trading day, so they sell on average about 230 million. After that, it just keeps decreasing. I'm gonna come back to the decreasing part at the next slide, but hopefully this gives you the sense of the inventory build up before the Fed transaction, and then dealer would take the inventory and then they kind of compete in selling to the Fed. So rather than like, they don't actually build up inventory, they're gonna keep it zero, and they're gonna participate in the Fed transaction, and then they are just gonna get inventory from customers later on or something like that. It's not.
So
Right. Please.
Do we know that the inventories that they're holding are held in their own account, not on behalf of customers?
This is coming from the TRIS transactions data, and if we take out the so-called agency-based trading, so this is, for example, think about the principal-based trading. So as far as my understanding is like this should be their own trading accounts, right? Is that what you're asking?
Well, I was asking whether they have other undisclosed positions with customers that would make their risk exposure low and let the customers be bearing the risk exposure.
And except the very new issuance. For example, if I have a Bank of America, I got new issuance from my commercial bank side. That one that's shown up in the TRIS data. But everything else, as long as they show up in the secondary market trading, they are showing up in here.
Zhaogang, can we take a couple of? Oh, Thierry, go ahead.
Yeah. Yes. Is the size of the purchase known in advance to dealers?
You mean 230 million?
Yeah. What do dealers know about the size of the Fed purchase?
Yes.
In days before the purchase itself.
So this is 230 million is like the size of an average trade. The Fed trading size is like about 200 million, 150 million, 200 million, 250 million. So maybe this number is probably what you have in mind. Let's see if that is true. So if we regress this cumulative inventory on the total Fed purchase amount, that's about 7%. So Fed for each TB contract, so they buy like a total amount. Each dealer's average transaction accounts for 7% of the Fed's total purchase amount. Is that what you?
No, my question was whether dealers know in advance what's going to be the size of the purchase.
I'm sorry. Yes, they know. So this announcement is very detailed. On this day, I'm gonna purchase 200 million for which a specific TB contract. So everything is already set up. They pre-commit, they keep their promise.
So it might be interesting. It looks a little bit like it looks related to the literature on anticipated shocks and the way dealers build their inventory in advance, of a liquidity shock which is anticipated. This is something that has been considered in other markets already.
I see. Yes. Just to give you a quick answer, we had some checks about this. We did see a price move, like a trend. That's kind of like going on. I think as you know, like there is some papers about the treasury market issuance. There is kind of shape going on. We also kind of find a similar shape, and the shape is also different in some ways. We're still exploring that. Right now, we're just considering kind of like not over time, just at the day. They are selling to the Fed and what the prices they are charging relative to the cost. But you're totally right. There is a pattern going on. I'm gonna go backward. Chaojun, do you want me to ask you how far in advance? I'm sorry. Okay, so Chaojun, your question. I see your question. So it's about a month. Thanks for the question. So they do a monthly cycle every month. They tell you in the remaining month, in the coming month, every day, how many trades they are gonna do, and each trade, what is the size they want to purchase.
And it looks like the next chart seems that the dealers start building up inventory 60 weekdays ahead. So that is 3 months ahead of the actual purchase date.
Right. Right.
So the dealers
good question. So good question. So here you say like this is a TB contract, right? So it's like not like the trading day, the settlement day. So there is some kind of like a difference, a small difference is going on, like difference is going on here. I don't think we are, we don't feel like very strong regarding exactly which day they start to build up, because there are some nuances in terms of the empirical kind of like calculation. But the trend of the build up, I kind of feel like we do think there is a remarkable inventory build up. Which day exactly, 6 day or 40 day? There is some kind of nuances regarding, because of, there are different trading days on the same TB contract settlement at the same time.
Zhaogang, I want to add one point.
Yes, please.
So here the question is, although the actual announcement comes like 1 month before the actual trade, like is pretty much anticipated by the market, because the Fed has announced we're going to purchase 440 billion per month, and also they literally only their purchase is very regular, only purchasing the most liquid production cohort of TBA contract. So even though like the dealer has now seen the actual announcement, they're gonna very much know what's the Fed gonna do within the next 3 months, and the actual announcement is just adding a little bit more confirmation on that. So that's why you can see the build up inventory before that. Also, this is empirical curve. This is like what we've seen in the data.
Thanks, you. Right. Okay. This is the average dealer. As I said, there is the second element, right? Second element is a dealer symmetry. Just very quickly, as you can see, we classify dealers: large dealer, small dealer. There is top 5. This is like the rest of the 11 dealers. You can see there is a large asymmetry in the inventory build up of the dealers. Now you may ask her like, well, this is an event study, whether this line is really the Fed purchase day, maybe it's also coinciding with some other days. The most obvious one is whether it's a settlement day, right? So maybe an alternative story is like on the settlement day, you are trying to get more inventory and sell to the to fulfill your promised transactions. So we go to the pre-period before the Fed purchase even start. We look at the settlement day. Before the settlement day, you can see there is actually decreasing. There is no inventory buildup. Instead, there is a inventory decreasing. So why is the inventory is decreasing? That's because, as I mentioned earlier, the TB market is used for the primary market issues, right? So in the TRIS data, so as a dealer, if I got as a bank, for example, Bank of America, if I got the MBS from my commercial bank branch, that doesn't show up in the TRIS data. But when I'm selling them to other customer insurance company, it does show up in the TRIS data. So therefore, you are going to only see the decreasing, like the out part, the outflow part going on in here. Okay. So that's kind of like give us a little bit of a confidence regarding, this is indeed a strategic inventory build up to the Fed purchase rather than to something else because of something else. Okay. So now,
hey, can I ask a question on the?
Yes, please.
Hey, very interesting. Thanks. On the chart, the event chart, is that conditional on? Are you just looking at the dealers that purchase from the Fed?
Are you talking about this part, this one?
Yeah, that's right.
This is the primary dealers who have ever sold to the Federal Reserve. There are 20 primary dealers, 16 of them who ever sold to the Federal Reserve. Right.
Okay, I guess I'm asking, is that's conditional on a dealer having sold in a particular operation?
The answer is no. The answer is this is all 16 dealers. So basically this is like all 16 dealers. Like, of course, for some TBAs, then some dealer would not sell. For some TBA, they would sell, but this is all 16.
Right. Okay, I got it. Thank you.
Right. So they may not sold in one trade, but as long as they have ever sold, we're going to include them. Okay, so now let me tell you about the, so here is like we're providing support to our setup, right? So Fed purchase is large relative to the inventory capacity, and the inventory capacity in terms of the dealer is also quite asymmetric. That's the two elements of the setup. But coming out of the framework, the story are two implications also, right? So one is about fixing dealers, the other is like a large dealer versus small dealer, still dealer asymmetry. So let me first look at let's think about the first one. So basically, we want to look at a fixed dealer, and we think there are two cases, right? One case is the purchase amount is small. That's going to end up with competitive case, right? So the second one is like the purchase amount is large. They're going to end up with uncompetitive pricing. So that's the Fed is case 2. We need kind of like we have a null hypothesis. We need kind of a little bit of something like a control group. We're going to use non-Fed customers as the one that purchased a small amount, which is true in the data. So we're going to treat the non-Fed customer as case 1. The purchase amount is lower than even individual, a small dealer's inventory capacity. So in this case, we're doing, in that sense, we're doing kind of a comparative statistics on the Fed, on the purchase amount. You know, D is small here, D is large here. So when D is small, the price is equal to the cost. When the D is large, the price is larger than the cost. So in that sense, we're gonna see the so-called discriminatory pricing. The same dealer will charge Fed a higher price relative to what they charge to the non-Fed customer. So let me show you the empirical results just very quickly. So we're finding the same dealer selling the same TB contract on the same day. I'm going to come back to the same day, which is very important. But for now, for the same everything, the only difference is whether I'm selling to a Fed or non-Fed customer. Okay, so we have to do some match. We're able to match about half of the Fed transactions. And what we found is that selling to the Fed, the dealer charges about 2 cents, 1.9 cents per 100 par value, higher than relative to a non-Fed customer. This is about like 40% of the gross profit margin, which is about 5 cents. Okay, so that's kind of the first empirical implication coming out of the model before we go to the dealer asymmetry event, right? So this is implication. Even if there is dealer asymmetry, as long as D is large enough, we still get this uncompetitive pricing. Now, let me move on to the second one. Now, to the right figure, there is a large dealer and there is a small dealer, right? So the large dealer was a small dealer. The implication we have here is that if we, in case 1, if we are in case 1, competitive case, there is no difference, right? Because they are engaged in a price per trend competition. If we end up in case 2, right? So there is a difference because, you know, this is an uncompetitive case and stronger dealer is stronger in terms of selling prices and the selling amount. So we're gonna compare the large dealer versus small dealer, first to the Fed and then to the non-Fed customer. And we're gonna say this is positive and this is close to 0, or in fact, we found a negative, okay? So selling prices to the Fed and amounts to the Fed, you can say that is both of them are positive, consistent with the implication. Right, so large dealer, we regress the selling price on the dealer inventory capacity. This is measuring large dealer, small dealer. So large dealer charge higher prices, selling more to the Fed. This is only to the Fed, not to the non-Fed customer. So quantitatively, we do 1 standard deviation of capacity. This is like about 20% of the average gross profit margin, 5% more in the Fed purchase amount. Now, what is interesting is that think about. Sorry, this is basically this leg. Now I'm moving on to this leg, right? To the non-Fed customer. Still large dealer versus small dealer. So large dealer versus small dealer, we're only considering prices because in the data, we cannot control individual customer, right? So we don't have customer identity. So we cannot control that. But for the Fed, we know that's the Fed, right? So different large dealer, small dealer selling to the same Fed, and we could think about their differences, right? So for non-Fed customer, we're just thinking about the prices, putting them together. So large dealer, they're actually selling at a lower price than the non-Fed customer. Quantitatively, it's quite small. You know, 1 standard deviation capacity only means if we take this number, is about only like half a cent or even lower, less than half a cent. But most importantly, you know, case 1, case 2, they are indeed very different, right? So what our take is that either this is like close to 0, or if you want to take the negative sign literally, it's more implied that large dealer, their cost is even lower, but they still charge higher kind of markup to the Fed. So they are indeed earning some kind of like some markup in there on top of their, you know, cost. So that's kind of like the second thing, right? I think I'm gonna, I only have like one set of results. I'm done, and then I'll take more questions maybe, right? So sorry to keep you the questions. So hold on a little bit, right? In terms of the cost, like there is alternative cost story clear, right? So we want to see. Let's just think about this part. It's a kind of a discriminatory pricing part. When we say non-fed customer to fed customer, we just want to see D is changing, right? We fix everything else, right? Somebody, like you may say that, well, maybe when D is changing, we are also changing the X1 bar, X2 bar, right? Because selling to the non-fed customer, you don't need a large inventory. Selling to the fed customer, you do need a large inventory, right? So that's going to give you a difference, not only about D, but also about X1 bar, X2 bar, right? So what we do now, we're coming back to what I emphasize, same day. So what our empirical analysis here, as you can see, is the same day, same dealer. So therefore, when the same dealer in our analysis, the result should be interpreted as the same dealer on the same day, they are selling at the same time to the fed versus non-fed customer. The MBS they take selling to these two different investors are coming from the same inventory. So therefore, X1 bar, X2 bar should be the same relative to non-fed versus fed customer. So that's kind of like the results we use to say this is against the the alternative cost story. Okay. We have additional report results here. I'm gonna skip that, and I'm gonna give you just one slide to give you to tell you or maybe two slides. One slide telling you what are different effects, and then second slide I'm going to summarize different effects just very quickly. So as you say, it's always a trade size effect. What we found is like a trade size markup, right? Because the Fed purchased larger. I mean, there is a good thing about executing the transactions quickly, but there is a trade size markup. But what we know from the literature, over-the-counter market literature, is that robust finding is that there is a trade size discount, right? So what's going on in here? Second, we know right now we are just treating Fed as a regular customer with extreme large purchase amount because of their policy target, right? But at the same time, the Fed also has some other features different from even an investor with a large trading size. They pre-commit on each day, each trading size, right? So they only trade with primary dealers. They don't trade with other counterparties, other dealers, right? So that gives them a little bit of operational inflexibility, right? So we want to also separate this, also look into the dealers from the other perspective, from the perspective of the operational inflexibility. So I'm going to give you the summary when we start going into the regression results. So basically, look at the left figure on the Fed trading day. The Fed price is here. The customer who are buying from the dealers with the similarly large size is here. So this difference is capturing the difference in selling prices, not due to the trading size, because the trading size is the same, because both of them are having mega trading size. So this is what we call segment C, is operational inflexibility part. Now, look at this line. This line is just the customers. The only difference is the different customers trading at different size. For very large customers, there is a trade size markup. The larger you want to purchase, the more you have to pay. But once we go to the block size is, I think it's like the 10 million, if I remember correctly.
It's 10 million.
Right, 10 million correctly?
10 to 100 million.
Sorry, yeah, 10 to 100 million. Above, this is above, mega is above 100 million, below 100 million. So once you go here, the trade size discount, the robust finding trade size discount still shows up, right? So therefore, even for non-Fed customers, as long as you are large, you have to purchase a lot, it's larger than the dealer inventory capacity, you still pay a markup. Same as the Fed. It's not because of the Fed, it's because your purchase amount is large, right? So that's a generic economic channel. And here is like dealer, we're coming back to kind of like the competitive case, right? So, once your inventory capacity is larger than the purchase amount, we end up with the traditional trade size discount. Now, this is on the Fed trading day, going to the days without the Fed purchases. The Fed disappears clearly because there is no Fed transaction. Interestingly, this markup part is also disappeared. It looks like the Fed is giving the market a lot of pressure on the inventory capacity. They already take a lot. And for the rest of that, the dealer inventory capacity is reduced. The dealer inventory capacity is even smaller relative to regular customer. So therefore, there is a trade size markup. But without the Fed transaction, with a large pressure to the market, and then we end up with the traditional trade size discount. So that's kind of like the back to the case one, right? So let me quickly summarize, and then we can discuss more. So hopefully I show you some evidence regarding the Fed face larger range, and the larger range coming from two channels. One is the dealer inventory capacity channel together with asymmetry. This is kind of like about the kind of a generic channel. Second is about a little bit like the primary dealers privilege or the Fed's policy target to make them to pre-commit in terms of their transparency, right? So this is kind of the cost that they have to pay for the transparency. And the design implications related to this too clearly is like, you can slow down the Fed can slow down the purchase pace, right? That's related to the first channel. Second one is maybe the Fed can open up more trading opportunities to different people. This is what the Federal Reserve is actually right now is doing. So they are opening up the trading opportunities. So there are something we abstract away from. Hopefully in the future, we can go in deeper in terms of the theoretical direction of optimal design, so on and so forth. Sorry to defer the questions at this point. Thank you so much.
Thank you, Zhaogang. So folks, we have about 9 minutes until our official ending time, but I think we can stay as long as there are questions and as long as Zhaogang is willing to answer them. So just like before, please unmute yourselves whenever you have a question. I was curious what Zhaogang thought about the debate that sort of came up a few minutes ago between Evangelist and Zhaogang, I think. Evangelist said, since the Fed is dropping money off helicopters anyway, does it really care where the money goes? How do you guys feel about that?
Thank you. No, I would say no. As a former Fed economist, I'm not affiliated with the Federal Reserve anymore. But to this question, I'm still standing on the Fed side. The Fed wants to inject money to the market, but still they want to inject the money to the market taking a fair price, right? The thing about if you think of supply demand affect asset prices, so they do, and there is after taking into account there is a fair price. Let's say $120. So in terms of implementation, the Fed wants to purchase $120. It doesn't want to purchase $125 because that $5 only go to some people. That's not going to benefit the whole economy. So there is kind of a monetary policy target, which is about quantitative easing, credit easing, so on and so forth. There is an implementation goal. Implementation goal is that reduce the rents, reduce the trading cost. I think there is two different things going on. Thank you, Andrew.
If there are questions, just feel free to unmute yourselves. And while we're waiting for that, Zhaogang, would you like to go through the?
Yes, I can go through the questions in the.
It looks like Daryl and Zhaogang are having a discussion.
Can actually, I have a question related, which is that, so Zhaogang and I had a paper about QE auctions with the treasuries. I think the disadvantage of the treasury is that we do not observe how dealers accumulate inventories in the treasuries because there's no treasury trades available to academics, but there is trades available on MBS. So I wonder if you could conduct some analysis on the transaction quality of customers who sell to the dealers who then, and then turn around and sell to the Fed. So could the customers do better by directly selling to the Fed? Yeah, in other words, the spread charged by dealers, how big would that be? And do you have a judgment on whether that's bigger or smaller than the amount of technology investment costs that customers need to incur in order to connect to the Fed? I guess the broader question is, should the Fed open up its account for a broader set of entities? Thanks.
Right. Yeah. Great. Thanks, Zhaogang. Zhaogang and I had a paper earlier on the QE treasury auctions of the treasury. So there we are focusing on the specific trading protocol, the auction format. So I think what Haoxiang's current question is about, if we open up the trading counterpart, like trading opportunity to different counterparties, whether they are gaining a lot. I think we can conduct some analysis, but there is a limit because, we cannot. So if the data does not differentiate between different customers. So if you think about dealer A and B, if we know that some customers only trade with A, some customers only trade with B, if we can differentiate the different customers, we can conduct an analysis. But in the trace, there is no customer identity. We cannot do that. But what we can do is that maybe on the trading day, we can still differentiate about the transactions, like the dealer trading with the other customer side and try to kind of do some differential along that direction. I totally agree. Thanks. I can go backward.
I have a couple of comments.
Yes, please.
But I don't want to interrupt other people. First of all, when you talk about inventories, I would suggest describing what you mean by inventories earlier in the paper. I think what's going on is the dealers, maybe they're holding inventories in these assets, but they're hedging them by taking short positions perhaps in other assets. And so they have a kind of flat position. So your cost is really a financing cost. And the capacity that we're talking about is a financing capacity. And so you can think of your stock cost as a storage cost, and you can think of your financing capacity, which is probably related to the dealer capital, as their kind of size of their storage facilities. That was exactly what also Krebs and Schenkman, I think, were thinking about at the time, because we were also talking about storage facilities and optimal stockpiling. So that's one comment. And my other comment is, it seems like the bottom line here is the Fed gives up a small spread to the dealers. It's small because the market's very liquid. But it seems like you could eliminate that by just introducing a trading mechanism that allows the Fed to trade with everybody. Mina and I Mina, who's here as well, have this paper that proposes a kind of continuous scaled limit orders, where, and we're working on generalizing that with Peter Crampton, Eric Budish, and David Malek to trade multiple securities simultaneously. It should be very suitable for this market because the securities are all very close substitutes. But that gives you the ability, that creates a market where everybody by definition trades at the same price. So there's not this bid-ask spread cost in some sense, which I think you're capturing, that you give up.
Right. So yes, I see your point. So I think the thing is that here, clearly, I totally agree. If you open up the opportunities to more trading counterparties, for example, running limit order book together with all the participants, that's clearly, we're gonna. I believe the Fed will get better prices and probably competitive prices. But there is a benefit of using primary dealer system. From the Fed perspective, that I think is going on in there. I guess what is not clear is that in that case, you're gonna disintermediate the dealers, right? So if you open up the trading opportunities directly to the insurance companies, there are two issues. One, we don't know whether those guys want to participate because we don't have a large back office dealing with this kind of things. The dealers have an advantage in terms of doing this kind of intermediation. Two, from the Fed perspective, it's not very clear they want to do that because there are kind of positive side of the primary dealer system. They would argue. So I think we are also thinking about whether there could be we can model in some benefit and do some kind of optimal design somewhere in between.
Okay, but let me question what you're saying, because if the Fed's purpose was to have a cozy relationship with the dealers and subsidize them at the expense of the taxpayer, that's the exact argument they would make. And if you look at what's happened in other markets, and in particular the stock market, where it has been opened up to small traders, and it is a very low cost, almost peer-to-peer mechanism, not only do you see small institutional investors participating, but you see people trading from their living rooms. maybe, the problem might be that there's too much of it, but for the good of the people trading for the living rooms, but the Fed should like that because it provides more liquidity to the Fed. So what you're saying is that the Fed's model is that the stock market, the developments in the stock market are just something to be ignored because they contradict everything that is ever thought about the way it relates to dealers.
Right. Yeah, I agree. It's worth exploring. I absolutely, yes, I totally agree. Yeah. Right. I think
Zhaogang?
Oh, I'm sorry. Yeah.
Guys, do you mind if we go through the hands here for a second? Daryl has had his hand up
yeah,
for a while
I'm looking
now.
at like the hands list. Daryl is on top of the list. Right, please, Daryl. Sorry, Michael. I'll come back to you, Michael.
Sorry, Daryl.
Thanks. Sorry for getting in front of you, Michael. I'm actually interested in your question more than mine. But let me go ahead. I had a little interchange with Zhaogang in the chat. I'm interested in the case of the normal market versus stress market in which the Fed is desperate to take inventory out of the market, so there's more space on dealer balance sheets. So the dealers can think about this two ways, and I'm not sure about how they're thinking about it. One is, the Fed is desperate, a bit like in your oligopoly model. They have an inelastic demand, and we can give them a monopoly price subject to your Krebs-Schenkman approach. And so the Fed is going to get a bad price. The other way to think about it is a two-sided market a la Rocher-Tirole, which is studied in Yuan's paper for corporate bonds. And in this case, the dealers are saying, oh, fantastic. The Fed is willing to take inventory off our balance sheets so we can continue to take trades from the buy side we can buy their bonds at big discounts, make tons of money from buy-side investors who are desperate to unload their treasuries for cash. And we're willing to give the Fed a great deal, sort of a no-cost deal, because the Fed is freeing up space on our balance sheets for us to make more gains from our customers. So we really want to give the Fed a great price because we want to unload as fast as possible. And Zhaogang's reply was the Fed paid a cost of 0.7 cents relative to the market price. But now the question is, what's the counterfactual here in terms of market efficiency, going to Pete Kyle? If it's an all-to-all market, maybe that 0.7 cost to the Fed is actually a great price for the Fed relative to an efficient market price, which would be a much higher price than what the dealers were offering customers. So how do you look at this? Is it the former way that I mentioned, that your model in which the Fed is paying a cost to deal with oligopolistic dealers? Or is it a special situation in which it's a two-sided market?
I think, yeah, I don't think we are able to differentiate between these two right now. Maybe I think I should frame the kind of the tone a little bit more carefully. So the cost, what we talk about, the cost is purely just the implementation cost. But maybe from the benefit side, as Daryl just mentioned, so the benefits totally kind of dominating the cost is actually even more than that. I think both you and Zhaogang suggested to look into the direction of like a different type of like range. Is like they are standing between the Fed and the customers. Maybe they're not just getting like ripping off the Fed, they're actually ripping off the other customers. That's, I think, could be what is going on. So right now we haven't done any analysis there, so we should think about it. We should think about how to kind of get around the issue of the limitation on custom identities, I guess. Sorry, does this answer your question? Right.
Zhaogang, I want to chat in a little bit. Like, right. Adding a little bit. So, hi Daryl, how are you? So first of all, like we actually like, although in our period we do like one period there's during QE3, like that's in the middle of our sample period where the Fed become more desperate to buy this agency MBS. We do find our economic effect gets stronger. So when they are desperate, they're getting stronger. And second, towards like Rocher-Tirole and Krebs and Schenkman, but I don't think they are too contradictory. Rather, like for the two-sided market model, it depends on who is more desperate. And clearly in the data, I think what we see is Fed is more desperate in buying versus, and I think buy side on the other hand are less desperate in selling their inventory. So we see the effect is more on the benefit of dealers accumulating a large inventory so that they can later on charge a high markup to the Fed instead of the other way around. So maybe they are giving a good deal to customers who are willing to supply them with a lot of inventory so that they can later on sell at a high price to Fed.
Yeah, okay, I get your point of view. I'm just uncertain because we don't really know what the efficient price is. It could be that the Fed is getting a really great price relative to the efficient price, and the customers are getting a really awful price. Or it could be, as you describe, the Fed is getting a bad price and the customers are getting a kind of normal or not so bad price. But anyway, I get your point.
I totally agree. So we don't see the efficient price, both to the Fed and to the customer. So it's kind of hard to judge. Maybe I'll go back to.
Yeah, we have two questions, one from Chester, one from Thierry, and then we also cut off Michael. So
yes,
Zhaogang.
Right. Maybe I'll go first with Michael, because Michael was like very fast in there. And then I'll go back to Chester and Thierry, please.
Thanks, Zhaogang. Two thoughts. One is on the number of counterparties. So some important information you have in the paper is that over your sample period, due to operational limits, the Fed was trading via TradeWeb, in which it could only select up to 4 dealers to trade with at a time. And then after your sample period, it started using its proprietary trading system, FedTrade, in which it could go out to all 24 or all primary dealers at the same time. So anyway, just an important point thing.
Yes. Thanks a lot, Michael. So I didn't talk about this. I should have talked about this. So the reason I'm talking about, in the beginning, I make a claim that it's not about specific trading protocol exactly because we have a result. Even if we look into the period after, the transaction go back to the Fed trading system, the same system as the Fed purchase treasury securities, as analyzed in my paper with Haoxiang, all the results still hold. So it's the same thing. So sorry I didn't mention that. Thanks a lot for pointing it out.
Okay, and then my other question, my question or comment concerns going back to the dealer inventory buildup. Now, I'm not so familiar with the agency MBS purchases, so I've been looking at our website while you've been talking. And so for the monthly, on a monthly basis, the Fed basically says, over the next month, we're going to purchase 20 billion in MBS.
Right.
So for that monthly statement, there's no information about what's going to be purchased. Then
so,
it looks like twice a month, at least currently twice a month, the Fed says, okay, over the next 10 trading days, this is what we're looking to buy. And then, so when I look at that inventory buildup, it's going back 3 months. It kind of gets me wondering, is this dealers building up inventory in anticipation of what the Fed's going to buy, or the Fed choosing to buy where dealers have the inventory?
So I think there are a few issues. Let me just quickly try to clear up the first few. I think you would have answers to like some other issues. So in our period, so I think when you say monthly cycle and they don't only announce a total amount, I think that's like after, I don't remember, after 2015 and 2014. So in the early period, I kind of like keep the records. In the early period, they did announce kind of like on each day, they are planning to buy Fannie Mae 30-year, how much amount. So it's actually a daily planning period, a daily planning schedule. So like at certain point, they switch to monthly cycle. What I believe that's because dealers already understand, right? So dealers understand, so they don't have to say so like, very like everything, every detail. So now kind of like the monthly cycle runs on and on. Okay. That's kind of the operational thing, right? So do you want to talk about the last part regarding the inventory build up? I think that more better, better.
So I want to add a little bit on the institutional background here. So during this period of time, the purchase is actually very much anticipated. Like the Fed basically announced 40 billion per month, and that is they do that literally every single month. And the other part of purchase coming from the reinvestment program, which is also heavily predictable because you can look at what Fed actually holds, what's going to expire in a month. And given what the Fed is going to purchase, because they purchase so huge quantity, they really don't have much limit. They don't have much choice. They literally their only choice, if you look at the data, they actually only purchase the most liquid TBA contracts that's near the current interest rate and current like the production interest rate. And that's like they purchase that. So even though they have not announced the actual like for each on which day they're gonna purchase, dealer have a pretty much they can guess like you're gonna purchase that much and you're gonna only purchase the most liquid TBA contract, and we know what the most liquid TBA contract is. So I think that's the reason why they don't really need to see the actual announcement to start preparing for inventory, because during this period of time, I think the Fed purchase, they have been very transparent and they let the market know how much we're gonna do. And in the later period, when they do the tapering, they also know for after each month, we're gonna decrease by 5 billion. So it's very clear schedule that's given very.
Great. Yeah, so maybe I'll go back to Chester. Sorry for letting you to wait so long. Chester, please.
No problem. Thank you. So my question is going to be on a little bit different dimension. So the paper is highlighting the power of the primary dealers. I've thought a little bit about that in a different domain, which is the role of the primary dealers in their special advisory committee to the Treasury. This advisory committee has gotten a tremendous amount of attention. I happen to have been a member of other federal advisory committees, and the various federal advisory committees that I was on were completely impotent. They had absolutely no power. My impression is that this federal advisory committee has a lot of power, and it's also striking to me that it's composed of the dealers rather than of the customers, such as Vanguard, such as Fidelity, such as your favorite hedge fund.
Yes.
Does your paper either shed light on that, or do you have perspectives on that? It sort of comes across that perhaps the Treasury is in the pocket of the dealers.
Right.
That would be one. That's sort of one, at least one spin about the structure of this advisory group and why it's structured in the way that it is.
Right. Thanks a lot. Yeah. Thanks for pointing out the very important facts which we didn't address. We do not address in the paper. So there is the Federal Reserve, when they first began to purchase agency MBS in 2009, they actually hired 4 investment managers, 2 advisors. That includes, if I remember correctly, JP Morgan, Citi or something. And later on, they phased out those dealers, those kind of investment managers. I think starting from 2010, these guys are gone. It's just the Federal Reserve who are doing their purchases. Recently, in the COVID period, when they began to purchase, the securities they have never purchased before, corporate bond, stuff like that, they hired BlackRock. Of course, they go through a very kind of a formal process, and they kind of make it very transparent why they chose BlackRock. So to be clear, we haven't done any analysis along this direction. We hope we can do some analysis and to shed more light on, whether this is kind of like this is more close relationship would affect the trading outcomes or not. But thanks a lot for raising this issue.
Yeah, and there's one other point in passing. I'm not sure that hiring BlackRock necessarily the regulators should get a free lunch on either, because one of the as opposed to some consulting structure that's not active in the markets. I mean, one of the criticisms of hiring the largest bond purchaser is they might have certain perspectives based upon their business, even if they have a pseudo Chinese wall.
I see. Yes. Right. Yeah. I think recently, just speaking from the Fed's perspective, I cannot speak on representative of them. So recently, they are starting this formal process, like you can register yourself and they are going to evaluate you, but they do open up the opportunity to a lot of different investment companies to say if they are interested in participating. I guess it's worth some future kind of like explorations. If that is fine, I'm going to go back to theory. Sorry again, it's dragging too long. Theory, please.
Yeah, my question was about, you showed inventory buildup in advance of the purchase by the Fed. It would be interesting as well to provide information about the evolution of the liquidity of this market and the prices at which transactions take place before the purchase. That might help, to answer some of the questions by Darrell, for instance, on the nature of the effects.
Yes,
and then
I
had two other questions. One was about, I guess in this market, on the day of the purchase, you cannot take short position. That is, dealers have to deliver on that day.
Yes.
And my last question is, on this day, I mean, what is the nature of the bids that are posted by the dealer? Do they post limit orders? Because the limit order is sort of, a price and a quantity, and the quantity is a bit like a capacity constraint on what you are going to do.
Right. So I think there are three questions. So first one is about, what is going on during the inventory build-up stage. We used to have a price run-up, curve, but I persuaded you to take it off, but it probably is a bad thing to do. So we can put it back. There is a price run-up, just like you had in your mind. You predicted it perfectly. So second, and maybe the third one is the kind of like the trading mechanism in this TBA market. As far as I know, this is a little bit like similar to the treasury market. So interdealer trading, a lot of them, as far as I know, like 50% happened at the kind of interdealer trading platform, which is basically anonymous central limit order book. But customer dealer trading is almost kind of over 80% is still kind of the traditional way. Of course, they do kind of so-called request for quote, IFQ, which was similar to what Haoxiang analyzed in his CDS paper. Small size IFQ, 4 people, 6 people. You can request 6 quotes from dealers. So that's what's going on in the market. I think the last question is about whether in this market, the TB is a forward contract after the trading, you can still scramble for inventory. We don't find this is a very a substantial issue, but when we separate the large dealer, small dealer, you can see that there is indeed the large dealer, because they are selling a lot to the Fed, that's our guess. Maybe because they still need a little bit of more inventory, but that's just a pure speculation. So because we saw a slightly tick up in the next 5-10 days in their inventory, rather than like other small dealers after they accumulate the inventory, selling to the Fed, and then they keep decreasing. So maybe there is some shift away from some reallocation in the interdealer market from small dealer to large dealer, because large dealer they get the trading opportunity with the Fed. They won the auction in some sense. Do you have more to add?
Yes, so I just want to a little bit on the exact trading mechanism. So it's RFQ. So basically, think about in this case, the Fed say for given TBA contract, the Fed has scheduled like 3 sessions. Tell the dealer in advance that we're gonna do them, and on each day, the Fed gonna select 4 dealers to participate in those RFQ. So basically, it's only the quantity is known for each auction. The only thing that each dealer does is submit a price, and the Fed is gonna choose the best price. So that's the RFQ session.
Great, thank you. Theory, does this answer all your questions?
Yeah, thanks.
I'll make sure. Yeah, thank you. Right. Andrew, should I still take questions?
Yeah, as long as you're willing. I think the next one is from Zhaogang.
Zhaogang, please. Right.
Hi, Zhaogang. Thank you so much for the. It's very interesting. I had a question about the regression. It's about the mechanism. It's the Fed gets a penalty here because of they purchase large size, but in the regressions that you do, you control for the size. So basically, you're saying that customers,
right,
the non-Fed customer and the Fed customer, if they were going to purchase the same size from the same dealer on the same day, the Fed is going to get a worse price. So it seems that the price discrimination channel is not.
Good question. So yeah, very good question. So the reason let me just be very straight. The reason is that the euro trade discount we got when you throw in the transaction like size, most of them happen here, right? So when you use the effect, like the estimate from this part to control the difference of the Fed relative to other customer, that's a little bit like extrapolation. So what we found, the main point is actually that part is not actually a good way to control. So in fact, we don't want to treat this as a control. We want to treat this as the point of the paper because of the size. Does it make sense? So in regression, you do a linear, right? So this is like extrapolating because most of the transactions of the customers, non-Fed customers happen here. Effectively, it's like estimating here, taking the estimate as a control for trading size, put it here, but that's not capturing the effect. That's the point of the paper, right? Does that make sense?
Well, I understand the extrapolation part that, but doesn't because you're doing linear extrapolation, shouldn't, oh, I see. So this is the blue line is what you
extrapolate. Customer, yeah,
Got
this
it.
is a
Okay.
Fed, right?
Got
So
it, okay.
Take this part to this part, there are some, clearly regressions are misspecified, right? So all the linear regressions are misspecified in my point of view as an econometrician.
So just one additional thing.
Got it.
So to estimate segment C, so here we only use the customer trace of mega size. So the only large customer size. So for this, if we look at that, then we can precisely estimate segment C without the extrapolation bias because we throw away all the small trace. We only compare the large, very large trace to estimate segment C.
Yeah, just want to make sure. I thank you. Thanks to Andre, thanks to organizers, and thanks to all the participants for coming here, for raising so many insightful questions. So we really appreciate them.
And thank you very much for the very exciting presentation. So it looks like we've run out of hands. Unless, Zhaogang, do you still have a question? Your hand is still up.
No, that was very helpful. Thank you.
Great. So if there are no more questions, we'll wait for 5 seconds to see if there are any. I guess this is a great point to stop. Well, there is one last minute question in the chat. Is it possible for a dealer to estimate other dealers' inventory in this market?
I would say it's very hard to say. If I'm a small dealer, I absolutely know, Goldman has a large inventory. If he wants, he can build large inventory, but like precise level of the inventory, I doubt, they could estimate it that accurately. The only thing is qualitatively, I know you are larger, I'm smaller, so I know that.
All right. By the way, everyone who has put their questions or comments in the chat, we will package them and send them to Zhaogang and you later, unless you guys have already copy pasted them into your own files. So thank you very much, everyone, for coming. And Zhaogang and you, thank you for all the answers to everybody's questions and for the interesting talk. We'll see you guys in 2 weeks.
Thank you so much. Really appreciate it.